The left lane on I-85 northbound, Atlanta. 8:14 on a Tuesday morning in March. The traffic has not moved in 11 minutes. The light through your windshield is that specific pale gold Atlanta gets in early spring. Your coffee went cold 20 minutes ago. A Bloomberg anchor on your CarPlay is talking about interest rates. You are not listening. For the past 73 days, since the first round of interviews at Chick-fil-A's Innovation Center called The Hatch, you have been thinking about one outcome and only one outcome: a 2-year selection process. More than 40,000 people applied the same year you did. You made it through the psychological assessments, the leadership panels, the family alignment interviews. The acceptance rate is roughly 0.3%, lower than Harvard. At 8:14 a.m., your CarPlay displays a notification. 6 words in the subject line. You pull onto the shoulder. Your hands are shaking. You call your wife, then your mother. You text Marcus and Dayon in all capitals. That afternoon, you submit the resignation you have drafted 7 times. The entry fee to run America's most profitable restaurant chain is $10,000. A check you write from personal savings, not borrowed, not gifted. That is the requirement. You tell your wife that evening, "We made it." You think you just bought a business. The notification that arrived at 8:14 a.m. on a Tuesday morning in March. You did not buy a business. You purchased a license to operate one. The difference between those 2 sentences will take you 4 years and 1 certified letter to understand completely. 3 days before you submitted that resignation letter, your franchise attorney called. You hired him specifically to review the 280 pages of the Chick-fil-A franchise disclosure document. The document that almost no applicant reads from cover to cover before signing. The voicemail was 4 minutes and 17 seconds long. You saw the notification the evening of your celebration dinner. You told yourself you would return the call in the morning. You did not. You listened to it for the first time 18 months after you signed. In that voicemail, your attorney said 3 things. The first, you are not purchasing a franchise in the traditional sense. You are signing a licensed operator agreement. This is not a semantic distinction, it is a legal one. You own 0% of the business you are about to operate. Chick-fil-A retains full ownership of the real estate, the building, every piece of kitchen equipment, and the brand. His question on that voicemail was simple. It was 1 sentence. What exactly are you receiving in exchange for $10,000? The second thing he said, Chick-fil-A takes 15% of your gross revenue before a single operating expense is calculated. Then they take 50% of whatever profit remains. For context, McDonald's charges approximately 5% in royalties. The math is not a detail. The math is the entire game. The third thing he said was the quietest. Chick-fil-A can terminate your agreement with 30 days notice. No sale process. No buyout calculation. No compensation for the years you spent building the location. You walk out with your personal bank account and nothing connected to the business. He was reading from Item 17 of the FDD, the section on renewal, termination, and transfer that most applicants skip because the offer letter has already created a feeling of arrival. That feeling is the most expensive thing in this entire transaction. Here is the document your attorney was reading when he called you that evening. You listened to that voicemail on a Thursday morning, 18 months after you signed. By then, you had already fired 2 general managers, learned how to schedule 43 people across 6 daily shifts, and missed your daughter's first-grade spring recital because the closing manager called in sick. Let us put the full machine on the table. The average non-mall Chick-fil-A location generates $9.3 million in annual revenue, according to the 2024 franchise disclosure document. The top location that year hit $19 million. You are a trained sales manager. By year 2, you are running $9.5 million. On paper, that number should make you a wealthy person. What happens to it is the structure of what you signed working exactly as intended, not as promised. 15% of gross revenue leaves the building before you calculate a single operating expense. On $9.5 million in annual sales, that is $1,425,000 paid directly to Chick-fil-A Inc. every year, off the top. Then labor, food cost, rent, and equipment consume another 61% of gross. What remains, approximately $1,875,000, gets split in half. Your share is $937,000 before taxes. After federal income tax at 37%, Georgia's flat tax and self-employment levies, your take-home sits near $560,000 a year. $560,000. To work 60 hours a week, 6 days a week, inside one building you do not own, with no permitted active side investments, no business asset to show a bank. That is not a failure, that is the median. And here is the part nobody on social media will show you about what happens to that number over 5 years. Your revenue climbs every year. Watch what your actual take-home does at the same time. Here is what surprises most operators. Revenue grows every single year. By year 5, you are running $10 million in sales. But your take-home does not grow at the same rate. In year 5, after wage inflation and rising food costs, your actual net income may be lower than in year 2. Revenue up, paycheck down. Month 6, the drive-thru wraps around the building every day at 11:30 a.m. You are doing over $800,000 a month in sales. The profit share check arrives and you go to the BMW dealership on Peachtree Road. You text a photo to your college roommates. You deserve this. You are working 63 hours a week and you are telling yourself it is temporary. The new general manager will absorb load once she is trained and settled. You miss your daughter's spring recital because the closing manager called in sick and you are the only one who knows the safe code. At home, the conversation has the same shape every evening. Your wife asks how much longer. You say 2 more years until the operation is fully systematized. She stops asking around month 9. You tell yourself that silence means acceptance. It does not. Month 18. You sit across from a loan officer at a bank in Buckhead. You need capital to address a parking infrastructure problem cutting into your peak hours. You bring 2 years of clean P&L statements. Nearly $1 million a year in operator income. The paperwork looks extraordinary. She looks up from the documents and says something you will not forget for the rest of your career. We can use your personal income for the mortgage qualification, but we cannot use the business as collateral. You do not own it. She is not being rude. She is reading your contract. Your Chick-fil-A location generates $9.5 million in annual revenue. Its appraised value on your personal balance sheet is $0. The man 3 miles away who owns a Five Guys franchise pays $2 million in debt service. But he holds a business he can sell at retirement. You cannot sell anything. Month 30, your labor line climbed from 22% to 25% of gross revenue. Food costs rose 6 points over 18 months. Your revenue grew, but 15% of gross leaves the building every single month, regardless of your cost structure. Your take-home fell $40,000 from the prior year. It is 11:43 p.m. on a Wednesday. The restaurant has been closed for 90 minutes. You are alone in the back office with a spreadsheet. The same format you used to build sales territory forecasts in your corporate job. Except now the numbers are yours and they are moving the wrong direction. You are 41 years old. You have not taken a full Sunday off in 3 years. There is a version of this story where you walk away right now, bank $400,000 in personal savings, and go back to corporate with a story about the most intense 3 years of your life. You do not take it. Month 36. The calculus becomes clear. Every dollar you cut from labor becomes 50 cents in your pocket. Not in Chick-fil-A's account. In yours. You are a trained sales manager. You understand incentive structures better than most people in this industry. That understanding is about to become a liability. You begin requiring closing managers to clock out before finishing side work. You build shift structures that keep people just under the overtime threshold without technically crossing it. You use the restaurant's supply chain contacts and administrative time to quietly build a small consulting side operation in direct violation of the exclusivity clause you signed 3 years ago. You tell yourself everyone does this. You tell yourself the system has been extracting from you for 3 years, and this is recalibration. The people who work for you do not see it that way. Several of them have been at this location since the opening week. They kept this place running when you did not know the safe code. Month 42. A certified letter arrives at the restaurant address. 7 former employees have filed a complaint with the Department of Labor. Wage theft, off-clock labor requirements. The filing references specific shift records, specific dates, specific dollar amounts. Records that exist inside your own system. In your own handwriting. The week you imagined when you signed the agreement versus the week you actually built your life around. Chick-fil-A's legal team does not negotiate with operators who become a liability to the brand. The company's entire market value is built on a culture of hospitality and employee treatment that is uniform across 8,000 locations. Within 48 hours, you receive a second letter invoking Item 17 of your licensed operator agreement. Termination for cause: 30 days. You spent 4 years and 60+ hours a week building a $10 million operation. You leave with your personal savings, a non-compete clause, and a clear memory of what the loan officer said to you in Buckhead on a Thursday afternoon 18 months before everything ended. 3% of operators build a different outcome inside this same agreement. It is worth understanding exactly what they did differently and what the ceiling actually looks like when everything goes correctly from the first day. 2 possible outcomes inside the same $10,000 licensed operator agreement. Before you sign any agreement that offers substantial cash flow but zero equity, there is one question worth asking. Not of the company, of yourself. If I leave this in 5 years, what exactly do I take with me? The answer to that question is not a detail in the contract, it is the entire business case. The man terminated from that Atlanta location began reapplying within 2 weeks. He told people the next time would be different. He had learned what not to do. The new operator inherited 38 of his former team members still on the payroll. The machine did not miss a single shift. It never does. Tonight, approximately 40,000 people have applications pending with Chick-fil-A. 0.3% of them will get the call. Almost all of them will hear it as the beginning of ownership. The phone screen will not tell them what is actually being offered until they read 280 pages of a document most people skip. Knowing what the $10,000 does and does not buy. Knowing the agreement can be ended in 30 days with no asset transfer in your direction. Knowing the person who takes your place will inherit everything you built without paying you a single dollar. Knowing all of that, on I-85 on a Tuesday morning in March, would you still pick up the phone?